Despite the Fed standing by its commitment to bring inflation under control by hiking rates regardless of the cost to growth, there are signs that the market is beginning to speculate over a potential pivot because so many growth indicators are rolling over, such as the S&P Global US Service PMI dropping into contraction territory below 50. But with inflation making a new high and structural issues likely to persist, could an early reversal by the Fed risk recurrent upside price shocks, even if we see growth reset? That's the big conversation. It seems that investors have shifted their focus from rising inflation to slowing growth in recent weeks. Although consumer prices have reached a 40-year high and is nearing double digits, the market seems more concerned by the prospect of a recession. For most of the last 30 years, inflation was generally the product of growth overshooting to the upside and dragging prices higher. But today, it's rather different. A combination of rising input costs, supply chain shocks, and higher rates have arrived at a point when demand is already heading lower, according to several key leading economic indicators. And as these headwinds appear to have intensified recently, there are now signs of demand destruction, potentially tipping the economy into recession. Take, for example, the University of Michigan Consumer Sentiment Survey, which recently made an all-time low. Reading into the report, respondents have cited inflation as one of their main reasons for pessimism, impacting decisions to purchase housing and durable goods. This is also reflected in the NFIB Small Business Outlook for Economic Expectations, which reported a record level of pessimism for growth prospects over the next year. This particular report provides a good barometer for broader business conditions in the US economy, which is primarily comprised of small and mid-sized enterprises. And big business is also now reporting a sharp drop-off in demand, with the ISM Manufacturing New Orders Index breaking below 50, signalling contraction, whilst a rise in inventories imply that blue-chip clients have been over-ordering amidst the supply chain chaos of the last couple of years. And the story here is that demand has essentially been pulled forward, leaving fewer marginal buyers remaining, particularly as businesses battle cost pressures and brace for an economic downturn. Having been conditioned over many years to expect the Fed to capitulate at the first signs of economic equity market weakness, markets may now have to deal with policymakers who remain committed to hiking rates at the fastest pace since 1993, even as growth is faltering. The Fed has made it clear for now that it's targeting price rather than growth, and officials have been pretty candid about achieving their inflation target, even if it comes at the cost of a recession. But with the growth outlook really beginning to deteriorate, there are signs that bond investors are beginning to speculate on a Fed pivot. Last week, there was considerable futures buying of the 5-year portion of the US government curve, where yields could be in the process of making a topping formation, opening up the potential for significant further downside in yields. With the US midterm elections later this year, the Fed may focus on the preservation of strong labour market conditions rather than the threat of inflation. Employment is, however, a very backward-looking indicator and would need to deteriorate rapidly to have any impact on policy decisions. Inflation, on the other hand, is a tax on everyone, whilst a weaker equity market impacts a much smaller subset of the population. Will the Fed fight for the few or for the many? Whilst the probability of a pivot has now been raised significantly above zero, there are considerable structural issues that are likely to continue asserting upward pressure on prices. Supply disruption and geopolitical uncertainty remain the key threat to growth via higher food prices and also higher energy prices, which are contributing to a cost of living crisis, particularly in Europe. Although agricultural commodities such as wheat may have returned to levels seen before the Ukraine war began, significant uncertainty remains given the potential for renewed political tensions. Having signed a deal to unblock grain exports from Ukraine, a missile attack on the seaport of Odessa almost immediately afterwards highlights the potential for volatility. And even more pressing, particularly for Europe given her reliance on energy imports, is the price of natural gas. Now, unlike wheat, European index natural gas futures are once again heading higher, trading at a significant premium to the equivalent US benchmark. It was hoped that the reopening of the Nord Stream 1 pipeline after 10 days of maintenance would see supply resume at the same 40% capacity as before, but a dispute over sanctioned parts has resulted in flows being limited more than was previously expected. But this further reduction in supply of natural gas has seen the European Union become increasingly concerned about the potential for the energy crisis to worsen over the winter. German baseload power is trading right at the top of a wide range set over the last 15 months, and may remain elevated if the supply constraints on the European energy market persist. So whilst investors have begun to speculate over the possibility of a Fed pivot, there are clearly major factors at play when it comes to the global stickiness of high consumer and producer prices. And although the US isn't as reliant as Europe on energy imports, it is likely that we've seen a peak in cheap energy, and this may constrain the ability for prices to reset to a sustainably lower level. US CPI needs to pull back and not just to peak. The month-on-month change was 1.3%. This needs to drop significantly if it's to get anywhere near the Fed's target levels. And even if an economic slowdown materializes, one of the biggest risks to higher prices is an early pivot by the Fed that supports growth and price before prices have been properly brought under control. And if you've got any questions about this episode, financial markets, or the economy, please put them in the comments section or send them to fmt@lseg.com.